Yes, that is correct.
Okay. Next question is, how does the size of the bars in brackets it says volatility affect your decisions? So I'm assuming the actual price action bars is what he's talking about.
Okay. Well, if what we're referring to there is if you get a wide range bar, Todd, correct me if I misunderstood the question, but if you're getting a wide range bar and you get a couple of those, how does that affect my decision to trade or not to trade? Does that sound about right?
That's how I'm interpreting this as well, yes.
Okay. Well, the first thing is, let me go ahead and get my highlighter on for a minute and get some white screen for us. You'll recall uh, in my normal YouTube-based videos and in the channel, I've gone ahead and talked about, what we like to see is if you got a support level and the market comes down below it, like to get a bar that breaks down below on heavier volume and another bar that breaks down even lower and closes within the bottom 50% on both of those bars, okay, and then has a retracement, preferably back to a falling like 20-period moving average or some sort of my speed lines. It falls back to something and then goes ahead and goes down. Now, the thing is, what we find sometimes though is when you get these wide range bars, you'll find that sometimes they go ahead and go all the way down to the next support level. So basically taking out a lot of the profit we were hoping to go ahead and get. Instead of coming down here a little bit, coming down a little bit more, coming back up here where you can get in up here and enjoy the ride all the way down, you get the two big bars that go ahead and come all the way down to your support. So what you have to weigh then is a different type of strategy. And I talked about that a little bit. Well, actually, I talked about it a lot yesterday. I talked about it a lot in setups video that you need to go ahead then and adjust your strategy. Um, you need to go ahead and look at, okay, do you really want to, if the profit has all been, where your profit target has already been hit by the original two bars, do you really want to go ahead and take the short there? If you do, then you need to ask yourself, do you want to use the scale-in strategy like I've taught in the past couple webinars and hit that heavily, that whole scale-in strategy, because there is certainly when you've had wide range bars, that doesn't mean that the move is over by any means. In fact, wide range bars sometimes kick off the big moves. As we talked about yesterday, we had the conversation about like the different waves. And one of the conversations was like we were talking about wave three, for instance, and Elliott wave, and how then it's like, do you expect after something like that, do you look for another move? And my comment was yes, because as you go ahead and you get these initial thrusts and you get this first strong move, the market will typically go ahead and coil back, recharge its energy after some of the profit takers come in, and you'll get wave number two, which would actually be wave number five. And this be a number four here, and this be a number five here. You get one more final wave of buying. So when you get some big wide range bars, that doesn't necessarily mean it's the end of the move. The market could just be coiling back and then getting ready for another move. As we go into yesterday's trade, let's look at that. We had some wider range bars that went and kicked off yesterday, and then we actually had some later in the day. Wider range bars will go ahead. Here we had an example. Again, let me get the highlighter on. It'll be like that. Here you had two wide range bars that kicked off the move. You had a pullback to my speed lines, and then you had several more points of movement. So wide range bars in themselves don't go ahead and keep me from trading, but what they do is they go ahead and they make me adjust my style to consider going ahead and moving to my scale and strategy. If I'm looking at because obviously by its nature, if the market's moved a lot in a very short amount of time, what's the risk? The risk is a strong pullback. And what happens is, and this is what's terrible for so many traders, I see them do it, it's very destructive behavior. The market moves. It's been typically what happens is the market's been kind of nicely trending down. It's been going down, and like, shoot, I should have sold it short here. I should have sold it short here. Keeps kind of going down, and then all of a sudden has two big moves, down, something like this at the end. Now suddenly they didn't want to short up here. They didn't want to short up here. Now suddenly it moves all the way down here and they want to short. Okay, and I've done the surveys the last couple of videos. I already know that many of you have done this. I've told you. I've even gone ahead and done it at points in the past. It's human nature. It's psychology. You don't want to go ahead and miss the trade. And so what happens, though, is what do people do? If the average for the S&P minis, with the surveys I've done, people were trading anywhere from 1 to 2 contracts to 12 to 20 contracts, with the average number of contracts being about 6 or 7 contracts. So let's just go with that number for a minute, 6. What happens is, rather than somebody saying, well, first of all, this is kind of more of a blow-off pattern. When you get the stair-step kind of action, and then you get the 2 big bars, that usually is, kind of a blow-off, where you really want to look at the 2 big bars being more of a beginning of a trend is as you've been coming down, and this is your 20-period moving average now. Work with me here and understand that's supposed to be a 20. The market's been coming down, and all of a sudden we bottom out. We're at the 20-period moving average. Actually, we've gone down below and come back above. And all of a sudden we get some wide range bars and some excitement back above the 20-period moving average and energy moving away from it. What usually happens then is when that happens, the market pulls back and either the 20-period catches up or it catches up to my speed lines and then goes and starts to rally again. So basically you're looking for the 20-period or for the 2 big bars to be near the beginning of a new move where the 20-period moving average is going ahead and turning around. Okay, whether it be up or down. Let me clear the screen here real quick. So actually, the market's been coming down, and actually the market with the 20-period moving average will be on top of it. Okay, but what happens then is you get this bottoming pattern where things the market starts trading sideways, chopping everybody up really badly, back and forth. And then all of a sudden what happens is you get some big thrusts. You get one more like move, kind of fakes people down sometimes. Then it turns around and powers right back up above the 20, get another bar going up, and then that's a great opportunity to start going in and looking at 1 or 2 strategies. Number 1 is scaling in. And see, this is what I got to encourage people with these wide range bars. What people want to do is they want to take their whole bullets, all their bullets, which in this case we're talking about 6 bullets, they want to put them all in right here. Well, what happens? This is around the 1145 level. The market goes ahead and pulls back. Oh, 1135. Well, you better have been stopped out if you went ahead and had, I hope nobody has 10-point stop losses unless they're going for 10 or 20 S&P points. Then something's terribly wrong if you're taking 1 or 2 point profits and going in and take 10-point losses. Sadly, I know some chat room commentators have actually done that. They profess, they talk about these big stops. You got to have big stops. The S&Ps are a big game, for big boys and whatever else may be out there. All these comments that I hear. First of all, the S&Ps aren't just a boys' game; they're also a ladies' game too. There's some great women that trade the S&Ps, but beyond that, the whole concept of taking your losses and letting them fall against you several points, but then you have some of the same people say things like, "Hey, it's never too early to go ahead and take a profit, guys. Never too early to take a profit." So when that's a sign of danger. But sadly, that kind of mentality does trickle into real traders trading then. And so what I encourage you to do is if you have 2 wide range bars, and to get back to the question then as relates to me, I will not dump all my contracts into the top of a multi-bar wide range bar movement. What I would do is look at going ahead and scaling in. So if, for instance, if you only have 6 bullets in your chamber, you got 10 points to the first rising support level. okay, then you got to sit there and say, how am I going to divide my bullets? I don't want to miss this move if I think it's going to keep going up, but which I would actually I'd encourage you to exercise caution, because if it has truly moved 10 points away from the moving average, you could see easily a 5+ point pullback before it even hits my speed lines. So, I'm not recommending people to be reckless and careless, obviously, with their money. What I would say is, if you feel that this is going to continue up, maybe a news announcement came out that they just got Bin Laden, Osama Bin Laden's been killed or captured or killed, whatever, or the bailout, took place with the $700 billion bailout, so that this is a fundamental change from the really negative news that we had to a news-driven market that could last for several bars. I would still not say don't dump 6 contracts in here. I'd say look at going ahead and maybe put in one here, maybe put in another contract 2 points away, 2 more points away. You could put in another contract until you reach this rising support level. That's at best the way I'd want to go ahead and trade a wide range bar. So yes, 2 wide range bars do impact the way I trade, because I don't dump more size into wide range bars. I dump less size into wide range bars, waiting for them to pull back to a reasonable area of rising support, in this case of a long, and then go ahead and look to add more contracts, especially towards the support, so that when it bounces off and rallies back up, I have a real nice basis of my entry, my average being down here. So when it goes back up to this level, I'm making a lot, a very good amount of money. So I hope that answers the question, Todd, how I will perceive wide range bars and how they affect my trading style.
No, that was a great explanation. And speaking of explanation, can you explain what would need to be done, adjustments, modifications, etc., to apply your concepts to shorter or longer time frames?
Okay. And we did go and talk about this a little bit yesterday, so let's go ahead and kind of recap some of the thoughts we had yesterday, which were that actually, Todd, can you hear me?
Yes.
Okay. I had a little symbol came up on my screen here that made me think that maybe I was muted or something, so I apologize. Just want to make sure everybody hears this. Okay. As you know, I like to trade off 15-minute charts. However, as we talk about the different styles that are out there, we have 1-minute charts, 5-minute charts, tick charts, hourly, 2-hour. So let's go ahead and look at the 5-minute charts here for a minute. And many of the same concepts still go ahead and apply as they do at any other time. What I'm looking for is, let's go to the extreme here. Let's go to the 1-minute chart, because they work even better on the 5-minute chart. So the area where it's highest risk, if you will, is like a 1-minute chart. But the concept still is the same, and they do work. What I'm looking for, if I'm trading a 1-minute chart, if I'm trying to trend trade, I want that 20-period moving average rising if I'm going long, okay? And if I'm wanting to go short, I want that 20-period moving average to go ahead and be falling. Here's what happens more often in the 1-minute charts is you have more possibility for whipsaws back and forth around the moving averages than, say, a 5 or 15-minute chart. Okay, so that's one thing you want to be aware of. But overall, and that's why I'm just going to try to pull up more data for you here. Overall, does it work better? Here was an area of some chop back and forth, but you see also then the 20-period moving average was actually trading flat. When you actually get the moving average going in trading in an angle, especially that 45-degree angle I like to talk to you guys about. Let me get the orb here. I like to see those angles, those nice angles like this. I don't like my moving average to be trading like this or any semblance of that, slightly up, slightly down. I don't like this. I like my moving average to be trending nicely. Okay, when the moving averages are trending nicely, either up or down, you get your best moves, and that is even on the 1-minute chart. Okay, so for my 1-minute chart traders amongst us, my encouragement to you is to go ahead and make sure that when you take your trades, using my methodology, using my setups here, and using my indicators and such, go ahead and make sure you've got that nice trend. So when you're going long, you're buying the pullbacks to the rising moving average, which you see how nicely it worked here over and over again for about, well, roughly an hour or so, just looking at this portion. But again, when you're trading flat, the moving average starts trading flat, you have a risk of being chopped around. So try to get the moving average trending in your favor. Okay, and then even on a 1 minute chart, the 200 period moving average and the 50 period moving average, so the 200 minute, the 50 minute, as far as I'm concerned, are equally as important as they would be on a 15-minute chart or any other chart. So that's why all the concepts are basically the same, except that you run a little bit more whipsaw risk in the 1 minute charts. And I really like to emphasize for the 1 minute, 5 minute traders amongst us that they really pay attention to the angles on the 20 period moving average in particular. Okay, so Todd.
Okay, well that actually answered our last emailed question, so we can go ahead and open it up for people to type in questions relevant to indicators and moving averages, support levels, Fibonacci's, those types of things. So you can go ahead and take a few minutes and do that right now.
Okay, and also I'd like to interject here for a moment. I'd gone ahead and asked Todd to go ahead and I'd asked Tom, one of our viewers here today, who's been with me for months and gotten to have a lot of great conversations. Actually lives in the next state over from me, to remind me, and I just remembered myself on it, which was the ADX. I want to review the ADX indicator more with the gang today. A little something special for them, people that are here. So I'm going to go ahead and do that too, Todd. But let's give people a chance to ask some more questions, and then I want to review the ADX some more.
Okay, well, we have one question from Joe, Robert.
I thought we weren't allowed Joe to ask questions.
Oh, that's right. You know what? I keep forgetting that.
Well, now you already put it out there.
I think he's just using different names.
Yeah. All right. What can we do for our great friend in the UK?
Joe would like, as a question, could you explain how you use your long-term charts / indicators to create your trading plan for the day?
Sure. That's a great question, Joe. I wish more and more people would put more emphasis on the long-term picture. There's absolutely nothing wrong at all being a 1 minute or 5 minute type trader. Nothing wrong with that at all. I just want to go ahead and make sure that people understand if your monthly charts, your weekly charts, your daily charts, and your hourly charts and your 15-minute charts are all going ahead and saying sell, you're probably going to get a heck of a lot better trade on your 1 minute or 5 minute chart trade if you're shorting than if you're trying to go long. If you're trying to fight the trend at the higher levels, you're going to go ahead and have less success than if you go ahead and have trade with the trend. Because when you got to remember now, there's all these different market players out there. There's the mutual funds, the hedge funds, and then the hedge funds. Boy, I tell you, they're a real eclectic group. Some of those guys are trading 1 and 5 minute charts themselves, and some of those hedge funds are trading hourly charts, daily charts, and so on and so forth. With the hedge funds, you get a lot of money dumped into those funds, trading all sorts of different types of styles. So, but the key takeaway from that is they are trading these multiple time frames. So the more time frames that you go ahead and have in your favor, the better the trading is going to be. So what does that mean to me? Well, as you guys recall from my YouTube videos, I like to go ahead and actually show you guys. In fact, let's just remember I have this kind of broken down, my daily chart or my intraday charts, my daily charts, my longer term charts. So, but what I like to show you guys right from the get-go, I've shown many, many, many times on YouTube, okay, this is the multi-year chart of the S&P 500 cash index. So here I am, even on YouTube, going ahead and showing you that I understand the long-term environment for the charts is very important. And as far as I'm concerned, even with the the fundamental news that we had here on the $700 billion bailout, it's funny, we talk about the government and we talk about the bullets being used up in the gun. What happens if this market starts to sell off at this point? And this is not a political discussion at all. This is actually a trading discussion that I want to share with you guys. I've not shared this in any other video, but I want to share this with you guys here today. I want you to think about this just for a minute. We've gone ahead and when the market, if you look at where we're at, okay, we're right here at this level, and look at this from a historical perspective. All we are is right here. And the government just went through this extraordinary measure to go ahead, stop short selling in a lot of financial stocks. They went ahead and just put together a $700 billion package. They're buying up all these different companies, and Fannie Mae and Freddie Mac. We're really, if you think about it here, were those kind of extraordinary measures put into place after 9/11? No, they really weren't. Here was 9/11, and then the subsequent, secondary sell-off here, and nobody got that aggressive when we were here. But then we go ahead, and now we're only here. And look at the retracement level here from a Fibonacci perspective. Let me just put that up for a moment, and this is just kind of an interesting discussion to have with this group and what this could mean to us in the next couple of weeks. But if you look at this from here to here, we've only gone ahead and retraced roughly 50% from back in 2002. So how bad, really, was it? But boy, our market sells off a few thousand points now, and the government wants to start buying everything up. Well, here's what I submit to you is, great, we just blew $700 billion worth of bullets from what it looks like in overnight or over the weekend news and that. What happens at this point now if we go ahead and continue to sell off? Okay? Remember now, I've taught many times in my YouTube videos, if what you expect to have happen in the market doesn't, get out. And if you're not in a trade, use it as a great shorting opportunity. Okay, well, what should be happening, basically, supposedly, with all this great news about bailouts and government stepping in and so on and so forth? Well, the market should go ahead now, get back above my magic 11,700 level on the Dow daily chart and so on and so forth. And, I guess theoretically be off the new skies if you want to believe in what, the bailout's promising. But what happens if that doesn't come to fruition? Well, so, I just want to go ahead and remind you guys that if what you expect to have happen, which is the market it should go up, doesn't, and we start to continue to sell off the new lows, and I'm going to show you that more on the daily chart, this could be just a very seminal mega event where we'd quickly see under Dow 9,000, or into the Dow 9,000s, excuse me. And let me show you the daily chart now. Okay, all this great stuff that's gone ahead and happened. If you look at this, let me tighten this up a little bit, give you a weekly chart. We were up here at 14,200 just last year. Now we're down here thousands of points lower, and you're going ahead and having a consolidation once again that I've been talking about for a long time in this area. If we, with this bailout, get above 11,700, well, that's good news. That's good news. You'll see my daily bias switch to a more neutral stance, be looking for certainly a lot more long opportunities and so on and so forth. However, if we go ahead and roll over from here, and the market goes ahead and says, that great $700 billion bailout, but, we still don't think this economy is in great shape, and we start to sell off after this, what's left, gang? What's left to do? We're going to get another $700 billion bailout? Is the government going to go ahead and, buy all of our houses for us, and bail us all out? I don't think so. I think, look at how much effort it's taking to get this $700 billion bailout. So what I'd say to you is, if we go ahead and we see this, seminal event, this mega event that we've had in the markets, where this starts continuing the sell-off despite all this, and we don't quickly get above 11,700, look for some mega selling, and those bars will be probably a lot bigger than this. Okay, just so you're aware. If the market gives out below these levels. So what's important is, as we talk about then what this means to Joe's question, and also I just want to kind of share that with you, which is you got two choices right now, as it relates to this bailout. Either we go ahead, quickly get above here. I just want to, this is something I won't go into a lot of detail on my YouTube video. I just don't have the time to do it, so I want to share it with you guys. If we break back below these lows, get down around 10,400, it's almost a certainty that you would see, 10,000, and really I don't think the buck would stop there either. Frankly, like I said, I think we'd see even further, because when you get a $700,000, $1 billion bailout, it's kind of like stocks. And I mentioned a similar example yesterday. If you get an earnings announcement, how many times have you guys seen great news come out on an earnings announcement, and yet the stock still sells off? Well, why is that? Because all the good news was already priced in. And if you look at the $700 billion bailout, the $700 billion bailout's been bought for days, okay? And so, if anything goes wrong with the bailout at this point, if the bailout is deemed to be weak in any way, shape, or form, it's going to go ahead and potentially going to have a very adverse reaction. And if all these buyers in here find themselves on the wrong side of the trade, like I said, I just expect some really, really ugly things to happen, and don't be surprised if it's short the farm type calls from me, at that point. So, but going back to Joe's question then, so one of the things I'm looking at from a larger time frame is, where are we in the macro view? Well, and I've shared my nightly videos on YouTube from the monthly perspective. We are in a multi-year downswing. Okay, what happens is, look, if you look at my moving averages, you'll see here when they crest over here and when we broke below the blue lines, it led to some huge selling. When we bottomed here and we broke above the blue lines, we went ahead and went into a 4-year rally. Well, look at what we're doing here, gang. We're cresting over again, and we've broken below my blue lines. So what would logic imply to you? Logic would say, from a multi-year mega event, that the odds are, and you also see then, of course, this is a multi-year double top. Somebody was asking, why don't I use, more top patterns and different types of patterns, and I actually do, as I mentioned in yesterday's video, and I actually pointed to this double top yesterday. So here we have a multi-year double top. We go ahead and, we are below here, and as you can see, just as you saw here with the crests and the troughs, here we are cresting again. So what would logic imply? Logic would imply we're possibly due for, another multi-year downturn. Okay, and you could see that very quickly playing out. In fact, look at this bar here. This bar back here was not 9/11, gang. That bar back there was, in 2002. All right, look how wide that bar was. Well, even here, we haven't made quite as wide of a bar yet. Okay, so however, if we go ahead and that bailout fails to go ahead and inspire people to get back up into this area, it very well could fail, and you could see a dramatic sell-off down to these areas. So what I'm looking at from a mega perspective, and why my bias has been bearish, and as you know, my calls in the YouTube videos and that have been very highly accurate, and this is part of that analysis that goes into it. So Joe, to your question, I look at the mega events, the seminal events in the market, and the long-term perspective, and right now the long-term perspective is down. Then I go ahead and I bring that to the daily levels, okay? And I've looked for the different types of patterns. I look for positive divergences in the daily charts. I look for when those divergences fail, as it did here. That was a great thing that we reviewed yesterday. I look for these types of patterns, reversals and things like that. I look for where we are, as I was showing you here before, where we are in relation to the previous highs. I'd like to just point something out. This is a weekly chart real quick. We've all heard, any of you that haven't, I'm sure will in your careers, that divergences don't work. Well, right here, we just have another divergence right here. You see this was on a weekly chart. Okay, you see how this peak here was lower than this peak, but the actual price went higher, and that was the top in in the market. This right back here was when people were asking me for my thoughts on where the market was going. I was a huge seller from their perspectives, and I have been ever since this time. In fact, you notice in my YouTube videos, all since this time frame when I first started the YouTube videos, it's all been about selling. You recall when we got back up to this level, I still was not willing to go ahead and be bullish. If you recall, go back to those videos, I said unless we break this level to the upside, I'm not willing to go ahead and be bullish, okay? And that was still really where we're at. In the short term, 11,700 has to be broken to be neutral. 13,000 area is where I'm looking at really to say, okay, the bear market is dead, and we have, opportunities for long-term gains to move up to Dow 20,000, okay? And so what am I using to look at all those charts and make that analysis? I'm looking at that off of a weekly chart of the Dow Jones Industrial Average. Okay, so these are things I'm showing you guys. Some of these things I'm talking about today, like this chart here, for instance, is something none of the other people have seen. I know that some people wanted to just come to my advanced webinar because they thought they knew everything. Some people only wanted to get my setups webinar because they think they know everything. They just wanted the setups. And then there's some of you that wanted to go ahead and, felt that you could learn no matter what webinar you were in, and you were willing to even come to a beginning webinar like this today. So for you that have enough humility to go ahead and admit you don't know it all, I'm trying to do special things for you guys, just so you guys understand why I'm talking about some things that you haven't gone ahead and seen in any of the other webinars today, because I really appreciate you guys being here, because the people that are in this room today, all of you, are the most likely to be successful for the long term in my perspective. When you can admit you don't know it all, you're more likely to succeed. It's the people that are successful doctors, lawyers, highly educated college grads and everything that have been very successful in their business careers. They go ahead and not all those people, but some. I'm talking about some in general. Sometimes people that have been very successful in their personal careers go ahead and suddenly say, you know what, I'm so slick, I'm so smart, I'm the CEO of my company or a high-level manager of my company. I can just go in and whip these financial markets too because I'm just a genius. Those people many times find themselves getting hurt very badly because the market is always right, not our opinions of the market. And what happens is people go ahead and sometimes develop opinions of the market, and because they're always so right in the things that they control in their corporate jobs, they try to impose their will on the market as well, and that ends up very badly for them, as you can imagine. So as it comes to you guys, for anybody who had enough humility to come to a beginning class and admit you don't know it all, I salute you. I really, really, really do. You guys know I call it like it is and I tell it like it is, and I'm glad you're here. So that's why the funny thing is I'm just showing you guys, and I kind of told Todd I was going to do that yesterday too. I want to share some things that nobody else has seen in some of the other videos. So with that said, Joe, just getting back to you, this this chart is very, very important to me, and yet you see it's a weekly chart, and yet it has a lot of bearing on what my analysis is then on an intraday basis for the my hourly charts, my 15-minute charts, because when I get the agreement, and in this case, sell side agreement, it adds strength to my conviction and more contracts, and which ultimately equates to more profit when I'm on the right side of the trade from all the higher time levels. Okay, and so the same thing applies then to the 1 minute, the 5-minute traders. It's nice to know where the mega trends are. People will say, well, what does a monthly chart or a weekly chart have to do with my 1 minute trading? Well, again, when you go ahead, and you got to keep in mind all those hedge funds and mutual funds, these guys are sloshing around billions of dollars. And just so you know, when I say guys, obviously I mean men and women. I mean, these people go ahead and are sloshing around billions of dollars in some of these funds. Certainly several $1 million in the majority of them. and they're not making their choices on a 1-minute or 5-minute chart. The hedge funds do generally, but the mutual fund traders or investors are usually not 1-minute, 5-minute players. So they're looking at, longer term, daily, weekly, monthly. So if you're going ahead and you're taking trades in the direction of where they're putting in their big money, what's going to happen? Well, let's just move this to a 1-minute chart real quick.